Well, Bruce, good to have you with us. First of all, how did you start Fair Home Fund?
Well, the Fair Home Fund was an extension of Fair Home Capital Management, which we started in 1997, and wanted to have a fund that was appropriate for all types of investors, from institutions to individuals, and hence the fund began. And we thought maybe build a fund, and if you build it and you build it well, maybe investors will come and visit the fund.
And you're now at $10 billion?
Yes, we've crossed the $10 billion mark, and we're just about having at the end of this year, we'll have our 10th anniversary, and it's been good. We've averaged over 12% per annum. The S&P's down about 3% per annum, so in other words, we're up almost every 10,000 is approaching 30,000, while 10,000 in the S&P index would be about $7,500 after almost 10 years. So
it's a quadruple in effect.
Yeah, well, now we just got to figure out the next 10 years.
Well, now your fee is a fixed 1%.
That's right.
And you also, of that $10 billion, how much do you and your executives have in it? You like the idea that investors are going to be in it, you guys should be in it.
Absolutely. So we have over $100 million of our own family money. It is in the fund, and absolutely, we follow the golden rule. It's we want a level playing field as best as we can make it level. So it's real important that we feel the pain and joy of our shareholders.
And you don't have other kinds of fees, 12B and all?
No front loads, back loads, trailing, just a simple 1%. The only fee we have is we want to avoid speculators and traders, so we have a 2% redemption fee that goes to the shareholders of the fund if someone buys and sells within 60 days. That's it.
And how many stocks are in this $10 billion fund?
Normally 15 to 25 companies at most. We're non-diversified, so we focus our energies, and we try and get at the concept of why not buy more of your best idea than your 60th best idea.
Well, as you put it, you can't date everyone.
Right, can't date all the girls.
And having 15 to 25, is that a page out of Graham and Buffett?
It sure is. It's a page right out. But you know, we have, after all, how many companies can I really know well over time and focus on a daily basis? So yes, and of course, for my days in math, I remember the central limit theorem. Once you get much more than 25 securities, you're going to be lucky to you'll be approaching the averages, and we're trying to beat the S&P 500 index. And we're trying to beat it with a lot of cash. On average, over the past 10 years, we've averaged mid-teens cash. That's something we've learned from Buffett.
And how much cash do you have now?
Well, we just reported, our last report, 17% of the portfolio is in T-bills. And that's about what the average has been over 10 years.
And this is cash that's earning, what, about 20 basis points maybe?
If I'm lucky. If I'm lucky, 20 basis points. But cash became extremely valuable towards the end of last year and the beginning of this year, so that drag is starting to pay off. But of course, as we invested, more cash comes in, and compounded interest truly is one of the wonders of the world.
Now, a lot of managers call themselves value investors. How do you distinguish yourself in terms of picking securities? You mentioned you keep a lot of cash on hand for opportunities. You only focus on a handful. But what do you look for in a security? Obviously, there's a lot of distressed merchandise. But what are the particular characteristics that get your jollies going?
Right. Well, the one key characteristic is cash. We basically count the cash that a company generates because, after all, what else can you spend? And frankly, I mean, investing, whether you call it value investing, whatever type of investing, is all about comparing what you give versus what you're going to get over time. So we give the cash to purchase the investment, and then it's our job to estimate how much that investment's going to pay us back over time in cash.
So you're looking for distressed merchandise that has a huge cash flow.
That's what we're looking for, free cash flow. I think Benjamin Graham called that owner earnings. Yes, what can be given to the owners of the company? I know it's a concept a lot of people aren't using these days, especially managements, but yes, we're looking to see what the shareholders will receive over time. And so capital allocation is important. We look at all the different ways where money is squandered, or how earnings aren't really earnings. We stick to cash because it's hard. So a dollar is a dollar. It's hard to disguise a dollar in the bank as opposed to a dollar of GAAP earnings where it could be a dollar, maybe it's nothing. And I mean, we've seen it with the airline industries, capital-intensive industries, where all these earnings over time have disappeared. And we've seen it with many of our big conglomerates over the past few years where great earnings were all wiped out.
You went through last year and early this year, and probably the worst period for any money manager to go through. How did you keep your head when, for a while in '08, you were doing just great, and then boom, the world fell off a cliff?
Well, the answer is I didn't keep my head. It was an extremely tough time. We were down 28% last year. It was better than most, but you can't spend relative performance, and we were down 28%. And it was very disheartening because I thought that we found the right places to be, healthcare and defense, given the new administration was scaring everyone about our health system and our military spending and the defense of the country. And given the recession-proof characteristics of those industries, we went there. But the bottom line is, when times get very tough, everything is correlated, and people need to sell whatever they have, and they sell what's most liquid. So even the baby gets thrown out with the bathwater.
When you went through that period, were you tempted at times to question your approach? Did you feel, my God, is this truly different? I better bail out, or how did you avoid giving in to panic?
No, I think there was no panic. I had real empathy for some of the shareholders who couldn't take the stress of prices going down, or for whatever reason, a lot of people discovered that leverage is a two-edged sword. And for those people who maybe have used securities to fund their lifestyle or leveraged up, they all hit that, psychologically or financially, a lot of people hit that line where they said, I can't take it anymore, and I just have to be out. But when something goes down in price, I know business schools tell you that if it goes down or up fast, that's volatile, it's riskier, but I don't see how a security, if it goes down 50% in value, is riskier than it was when it was double that price. So it's like grocery shopping. It's your favorite foods on sale, your favorite companies, you count the cash they generate. And there's not many times when you can find good companies with a double-digit free cash flow yields, which we found. And of course, when the panic sets in, then you have some tremendous bargains. We were able to buy securitized bonds for our fund that were yielding 18%. We got 18% yield to maturity, over-collateralized by 24%, and plus a humongous corporate guarantee.
One of these rare times where that kind of debt really was better than almost equities.
You received excess equity returns with senior securities in the credit structure. I only wish those times lasted longer. I'm afraid they're gone right now.
Certainly in the junk bond yields you see since early part of this year, that's gone down quite a bit, those yields.
It's amazing. I mean, we had like Hertz, a piece of Americana, who people thought, because of the recession, was going to go out of business. You were able to buy their bonds between 20 and 30% yield to maturities. But, of course, at the same time, the equity went down to low single digits, and so it's a bit of a turmoil for investors. In one case, 20 to 30% bonds are fabulous. On the other case, you know that if the bonds are money good and the company is good, you probably make 4, 5, 10 times your money on the equity over time.
One of your mantras is ignore the crowd, and that is focus on a handful of securities, and you have to worry, but you aren't going to get caught up in the euphoria or the depression of the market.
Yeah, absolutely. Almost by definition, we are running towards that which most people are running away from, because how else are you going to get a very reasonable, cheap price on a good company unless the marketplace believes something is terribly wrong? And but there are two ways